We're going to get right to it. We're going to show the chart that you've been posting looking at headline inflation. Now, according to your research, if you use alternative data specifically tied to shelter prices, we're actually at flat, 0% inflation right now compared to what the Fed would see. Give us a sense. What does that mean for the markets in the third quarter, the second half of the year? What is the potential hike coming up in July that a lot of people are expecting? What could that mean for the markets?
You're spot on, Frank. It's all about that shelter and how one key data point gives you such a different look at what's happening in the economy. Our shelter number using real-time data is basically flat when the core numbers used by the BLS is 7.8%. And so, saying that the Fed has an inflation problem, they continue hiking, puts us at greater risk of over-tightening, slowing down the economy, more unemployment, which gives more headwinds for the market than otherwise needs to be.
All right, so some headwinds for the market in your mind, because, again, according to your research, we're actually at flat inflation when it comes to the headline number. I want to look ahead to earnings season. We saw the big banks kick it off last week on Friday. What's your expectations for the rest of the earnings season? The forecasts are for a decline for a third straight quarter.
Yeah, I mean, energy is a key part of the decline. Their earnings were a lot higher last year. That's part of why inflation is coming back down, is because energy and oil is way below where it was last year. I think the big story, though, as you said, the Magnificent Seven, big tech has been running on hopes of this AI revolution and boom. Will that come out to earnings? There's a lot of inflated expectations in tech sector because of this AI boom, and will it be real? I'm a little worried that at 30 times earnings, the tech sector is high. The higher the multiple, the more you have to deliver on those earnings. So I do think that is one of the key risks that I'll be watching through this earnings season.
A big risk, but what about the rest of the market? We've heard a lot of people talk about the S&P 493, if you subtract that Magnificent Seven, actually isn't overvalued.
Yeah, we show S&P X tech is exactly at its median multiple for the last 30 years. So there's really no inflated expectations outside of the tech sector. Now, the tech sector is 40% of the market, so it's not an insignificant section of the market. But, there are definitely baskets. We have a high dividend basket that's only 11 times earnings. So there's definitely cheap segments of the market, but it's certainly tech that is commanding premium multiples.
So, Jeremy, you're front-running me. That was your pick, actually. You're looking at dividend-paying stocks right now. What's the argument for dividend-paying stocks? Because those ETFs and a lot of those stocks, they've actually lagged this year.
Well, so I think the S&P at 20 times earnings, that's a 5% earning yield. That gives you your outlook for the next, call it 5-7 years. At 11 times earnings with a 9% earnings yield, much cheaper. It's more defensive. It doesn't have those inflated expectations. So the market's been running on the AI hopes, but I think high dividend stocks is one of the ways you can protect from valuations and navigate this earnings season a bit better.
Yeah, we're looking at one of your products right now, the Wisdom Tree U.S. High Dividend ETF, ticker DHS. Hard not to notice it's negative for the year. So, again, what's the big catalyst to turn this ETF around?
Well, it's just more reasonable expectations. If there's choppiness, last year when the Nasdaq was down a third, this was up last year. So if there's a bit more of a downdraft, and again, we are worried about the Fed over tightening, I think this is a fund that can protect you from that volatility, much more reasonable multiples. I think that's the key story for this fund.